Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. On this episode, we're going to talk about what's up with the Bank of Canada and why are they increasing interest rates and what you need to know. Stay tuned, you don't want to miss it. If you're watching this video on the Team Sessa YouTube real estate channel, once again, thank you for tuning in. Thank you for all your comments. Don't forget to hit the share, like, and subscribe button and that notification bell to get notified every time we post a new video. And if you'd like to book a free consultation with myself or Santo, please feel free to do that in the description box below. We'll make ourselves available to have a conversation with you. And now, back to the video. What's up with the Bank of Canada? That's the million-dollar question that we're getting right now here at InTouch Mortgage Solutions. Obviously, on the tails of the Bank of Canada increasing its overnight policy rate 0.5%, bringing its new policy overnight rate to 1.50%. With conversation that they're going to be increasing that rate again in July. Are they going to bring it up 0.25%, 0.5%, 75 basis points? We're not sure yet as we wait for the inflationary numbers, the CPI data to come out for the month of June. But I want to hear your thoughts and suggestions on what the Bank of Canada will do in the comments section below. As we talk a little bit about the Bank of Canada, a lot of clients, a lot of consumers, a lot of viewers may not be fully aware of what the Bank of Canada's intentions are with these rate increases. For those of you that may or may not be watching the Bank of Canada, their press releases, all the conversations happening with Governor Tiff Macklem, obviously there's a lot of interesting data that comes out from those conversations, and sometimes they don't make the headlines. So what I want to do is just break down a little bit about what we see happening with the Bank of Canada and why these interest rate hikes are important.
When we indicate that we're prepared to move more forcefully if needed, what we're indicating is we may need to take more steps, more interest rate steps to get inflation back to target, or we may need to move more quickly, may need to take a larger step.
The Bank of Canada has a mandate, and their mandate is to keep inflation at the 2 to 3% range.
We want to get our policy interest rate back into the neutral range quickly. And we've indicated we think that range is between 2 and 3%.
Our mandate is inflation. We have to get that inflation back to 2%.
And anything above and beyond that is a problem for the Bank of Canada, especially now that we're at a 3-decade high at 6.8%. Now, obviously, as I mentioned earlier, we're waiting on the data to come out for May. We should get that by the end of June. And that will have a big hand to play in what the Bank of Canada decides to do in July. With that being said, the Bank of Canada has used some very strong language, very hawkish on their sentiments on tackling inflation.
Acting more forcefully also include a larger than 50 basis point in one go increase or not?
Okay, so when we talked about more forcefully, obviously we were kind of trying to think both in terms of pace and kind of level and speed of getting there, and that was part of our deliberations. We kind of thought about that, and we have to put this in context. We're seeing higher than we predicted inflation. We're seeing the economy's overheating, and we're scared that this inflation becomes entrenched. And so we see this aspect of potentially needing to go higher than we thought before, and we still have the idea that we want to get there as quickly as possible. So that could involve doing more moves in a row, or it could involve bigger moves. All this will depend exactly on the data that comes in. We'll have to try to, we're not doing anything on automatic pilot or anything that looks like that. We'll be kind of trying to analyze data as it comes in, figuring out what's the best, trying to have feedback from the economy at the same time as we take our decisions.
As we are fully aware, central banks, as well as the Bank of Canada, do not have control over geopolitical issues like what's happening in Russia and Ukraine. They definitely don't have any control over the supply chain and bottleneck issues that we're seeing. Oil, all these things that are pricing in higher inflation when it comes to the consumer pricing index. So the CPI bucket, which includes shelter and housing and energy and food, the 3 major components, all those things are more expensive for Canadians. And many Canadians are stressing and feeling the pain from higher cost of goods and of services as well. So if you're going to the gas pump, grocery store, obviously you felt the price pinch on those items. So the Bank of Canada has made it their mandate, their objective to do whatever is necessary to tackle that. And that means increasing interest rates. So basically, when we see inflation entrenched in our mindset as Canadians, and the Bank of Canada coming out over the last few months, giving forward guidance, saying, look, to Canadians, we want you to curb your spending. Stop taking on debt. Stop spending.
The economy is in excess demand. We need higher interest rates to take out the excess and excess demand, bring demand back into supply to get inflation down. Part of that adjustment will no doubt come through the housing market. That's part of getting inflation back to target.
But the important thing is really kind of bringing that that excess demand down, trying to kind of get people to rein in that extra demand, and we'll do the rates that are needed for it, and we'll be looking at how much and how the economy is reacting as.
And when you start to see inflation entrenched in the mindsets, and this was also in a poll, that many Canadians think that if they buy something today, it's going to be cheaper than it is 8 months from now. Now, although that may be true, what that's doing is continuing this self-fulfilling prophecy or the self-fulfilling loop of increasing the cost of items and continuously increasing inflation. And by doing that, the Bank of Canada, which is reactionary by nature, has to basically go ahead and hit that lever and increase interest rates more and more and more until we can bring in inflation and obviously interest rates.
If those highly indebted households lose their jobs, they would likely need to reduce their spending sharply to continue servicing their mortgage. In addition, a big correction in house prices would reduce both household wealth and access to credit, particularly among the most indebted households. Were this to affect many households, it could have broader implications for the economy and the financial system. This is not what we expect to happen. Our goal is for a soft landing with inflation coming back to the 2% target, but it is a vulnerability to watch closely.
So there's a lot of conversations being had about the mindset, the sentiments of consumer spending. Yes, the Bank of Canada is looking at the savings accounts, mortgages, indebtedness. Obviously, Canadians being heavily indebted, 186%. Basically, for every disposable income, every dollar of disposable income, a Canadian owes around $1.86. And that is a problem for the Bank of Canada, not to mention many Canadians being in variable rate mortgages and understanding the pressures that follow. Now, the Bank of Canada, obviously, in their press conference just recently had a question asked to them saying, would they basically, enact or sort of recreate or force a recession in order to bring inflation into control or into check? And that is a good question. The Bank of Canada's response, obviously evading the question, but basically leading off with, we will do whatever is necessary.
Putting aside what your current forecasts are for Canada's economy and the desirable outcomes, would you be prepared to engineer a recession if that was what was necessary to achieve the inflation target?
Okay. Our mandate is clear. It's the inflation target. That's what we have to do. We have to do what's necessary to get there, and we'll do what's necessary. But at the same time, we try to do it in the way that's the best for Canadians. But the bottom line is we will get inflation back to 2%, and we'll do what's necessary to get it there.
So will we see a recession? Will Canada enter a recession? Will the Bank of Canada cause it? Leave your comments below. Let me know what you think. But I think basically the Bank of Canada will do whatever it's necessary. I personally think we're going to see some interest rate hikes. Definitely a little bit of pain in the short term until we can get over some of the hurdles that we are facing.
What factors are causing you to hold judgment and not say that a correction or a steep decline in prices is coming?
Well, first of all, just let me underline that our primary focus is getting inflation back to target. Monetary policy is not housing policy. But the housing market, it's an important part of our economy, and we're certainly watching the dynamics closely in the housing market. Overall, we need to slow demand in the economy and bring it in line with supply. The housing market has been unsustainably strong. The level of activity, the increases in housing prices we've seen have been unsustainably elevated. And we are expecting to see some moderation in housing activity, and frankly, that would be healthy. The economy is overheating, and that is certainly part of the story. Looking at the dynamics of housing, we've been talking about high interest rates for some time. That may have pulled forward some of the activity in housing, so that could be a factor playing into the slowing. There are certainly some underlying strength in the market. Employment is very strong, wages are going up, immigration is rebounding. There are underlying underlying demand factors that will be supporting the market. On the other hand, we have seen a big boost in activity, and so it wouldn't be surprising to see some moderation.
Now, obviously, in the real estate market, all these pressures by the Bank of Canada have had a desired effect for many in the real estate market, depending on what side of the fence you're on. If you're obviously a homeowner, not so much. If you're a home buyer, you're seeing these prices come down and you're feeling a little bit more hopeful. So yes, obviously prices have come down. New listings are basically up as we see the sales to new listing ratios sort of lean from where we were previously a seller's market into the balanced. Maybe by the end of the summer, we'll enter into a buyer's market. I think we're almost there as we're starting to see clients that are going out there to put offers and they're actually getting conditional financing. They're getting home inspect. They're getting offers with conditions on there that weren't previously available to them. Obviously, it depends on the market, depends on the type of home, but with home prices changing, a lot of buyers are sidelines. We still have a couple of those pre-approvals that are pending in the pipeline with July, maybe early August expiration dates. Now, I take a second to look back here at what is happening. What I do draw in my mind a parallel to is what happened in 2017. And although the catalysts for 2017 and 2022 are different in what brought on this basically change in the market, the results or what's happening on the street level are the same. Back in 2017, much like we're seeing today, obviously appraisals having an issue. Some of them are coming in a little bit short, depending on when those properties were purchased. We're having clients that are feeling a little bit of, those pains that they may think that they purchased a home more than the current market value. And they're looking for ways to maybe try to escape from that contract. Obviously speaking with that real estate lawyer and understanding your outs, what you're entitled to do so that you don't make a mistake is important. But obviously, we're seeing this happen. We're also seeing clients that purchased at the heat of the market and now are trying to sell their homes and they're having issues. And obviously some of those clients who are approaching their closing dates on their purchase might be finding it a little bit more challenging as, they might have to distress sell or reduce that price further if they're not eligible to maybe keep their other home, pull out some of that equity. Speaking with your mortgage professional and understanding the solutions and options available to you are very, very important. Who you work with matters, and understanding someone who's been through this market and can sort of navigate through it, very important, so that you don't make the wrong decision. But with that being said, obviously, we're seeing these times changing right now and basically understand what's happening. Yes, interest rates are rising, home prices are changing. We're seeing some different distress in the market. If you purchased or sold, if you're a first-time home buyer looking to get into the market, this might be the opportunity, even though obviously interest rates are elevated. The cost of borrowing is more expensive. We're seeing now on the mortgage end of things are starting to change as the Bank of Canada increases that variable rate and their prime lending rate. What does that push the actual rate to, or the contract rate? Is it above the 5.25% qualifying rate? Is it below? Fixed rates definitely above, the 5.25% qualifying. We have to qualify them as +2, something we've talked about in a previous video. So understanding how these items are playing in, clients who wanted to go fixed maybe have no choice but to go into a variable, or maybe take a 1, 2, or 3 year product depending on the pricing. So obviously understanding that perspective and understanding what works for you as a home buyer and getting that pre-approval obviously being very, very important. But basically take a deep breath, look at the market and see exactly what's happening, understand what's happening. And maybe, as I said right now, for many buyers, it is a good opportunity for you to consider and have that pre-approval in hand in case you see something that you like and something that previously was maybe out of reach before is now maybe within arm's length of you grabbing that property. And we're seeing that happening with a couple clients that we worked with recently in the last week or two who actually went out there and purchased a home, something that was a little bit more expensive just a few months ago. They're able to score that property at almost $100,000 to $150,000 less than what the home was worth just a few months ago. Take it as it will. Is it good? Is it bad? Obviously, the market is adjusting. And what I think in the next few months, come September, August, September, we'll see things change, level off in the market, and we'll get a better picture of, after all these distress sales, all these closings that need to happen, filter through the system, what it's going to look like going into the fall market, and keeping that in mind. So I hope you found this video helpful. If you did, please make sure to hit the like button, hit the share button, and subscribe to our videos. Don't forget to hit that notification bell so you can get notified every time we post a new video. But on that note, we'll say goodbye. Have a great Friday. And until next week, thank you for tuning in, and we'll see you next week.